Guys, it's Sasha. The CPI data has just been published and the headline figure is at 8.2%, just above the consensus of 8.1%, but it's not the headline figure that matters. It's the components of the CPI, and the components look seriously bad. And immediately after the CPI data was published, the stock market fell another 3% in pre-market trading after already crashing over the last few weeks. Many tech companies and growth stocks swung from being 1 or 2% up before the data was published to being 3, 4 or 5% down. And the CPI data makes for very ugly reading. Despite what the media and many company CEOs have been saying over the last couple of months, inflation did not in fact decide to go away all by itself for the first time in history. I know, how weird. We've had everyone and their dog telling the Fed that they must stop increasing interest rates. Cathie Wood wrote an open letter a few days ago to the Federal Reserve telling them that they are dumb. Inflation is over. What are they doing? She knows all the answers, but here we are, and inflation is here. It jumped 0.4% month on month in September and is now running at 8.2% year on year. But it's all a lot more ugly when you break it down in a bit more detail, because if you exclude energy, inflation is getting a whole lot worse, and energy is making this look a little bit better because energy costs have fallen in the last 2 months as oil and gas prices have decreased. And that means that the overall inflation number is coming out at being relatively flat the last few months, but then go and look at some of the components that impact the lives of people on lower pay. Ultimately, inflation is really hitting these people way harder. It's not hitting the rich people who are buying new cars that might be a bit more expensive. Food has gone up substantially again, 0.8% month on month, and you can see that it's been going up about 1% a month right across this table. Every single month from March, that is seriously bad. Food at home is at 13% year on year, about the same as it was last month, and food away from home has dropped slightly. It's sitting a bit lower at 8.5%, but that is not as critical as the food at home bit. Then we have energy. Energy has come down month on month for the third month in a row. The last 2 months were largely down to oil prices falling, and this month we have gas prices reducing as well, which hasn't yet translated into electricity and utility gas prices in the index. So energy has fallen a lot and is now just 19.8% up year on year overall. I know just 20% up sounds ludicrous, but there we go. This big drop in energy is hiding what is actually going on further down in the table. Used cars and medical care commodities have dropped, but here is the most critical figure in the whole table: shelter. Shelter has gone up 0.7% for the second month in a row and now sits at 6.6% year on year. By the way, transportation has also gone up sharply, which is also going to hit people really, really hard. But let's talk about shelter, because I've been talking about shelter for over a year on this channel, pointing out how ridiculous and how problematic this figure is in the CPI index. The shelter figure is way, way under what the real change in the cost of rent and house prices has been. And this means that over the coming months, this shelter figure will continue going up every single month, regardless of what happens with rent and mortgage prices. And very likely, it will go up at a much higher pace than it is going up at right now, because the shelter metric in the CPI index is a lagging indicator. It is based on surveys and doesn't reflect the immediate changes in rent and mortgage rates. And there are 2 reasons why. The first is that surveys take time to translate reality into responses, but it also takes time for people to actually feel the hit of increasing prices. Because if you are on a fixed 2 or 3 year rental deal, you won't feel the massive increase in rates until it is time for you to renew or to move. If you own a property with a fixed term mortgage, which is what most people in the US have, you won't feel the cost of higher house prices and higher interest rates making mortgages way more expensive until you have to move. And when you do have to move, it is going to be mighty expensive. The Zumper report continues to show that rent prices are going up at well over 10% year on year. But they have already been going up at that rate for over a year now. So the shelter figure that we see in the CPI index doesn't just have to catch up to the 11% that rents are increasing right now. It has to also catch up to the 14% increases year on year that we were seeing earlier this year that haven't yet made it into the CPI data. House prices fell in July according to the latest data from the Federal Housing Finance Agency, which may be a sign of the financial difficulty people are beginning to face in reality, and it may help the overall inflation data going forward at some point in the future. But remember that house prices have been blowing up in the last year. This is just 1 month's worth of data, and if you go and look at the table just below, you can see that annual rates of growth on the cost of housing have been increasing by 16.3% since February 2021. So again, the CPI shelter data is way below reality, and shelter is 1/3 of the total index. So if the shelter number goes up from 6.6% that it is today to something more realistic like over 10%, we are going to have a very, very serious problem with inflation because the Fed cannot immediately stop shelter from going up. There's nothing they can do immediately to stop that number going up because remember, shelter is a very slow lagging indicator. Now, energy costs dropped sharply in August because oil prices came down, and as expected, they fell again month on month in September. In fact, for much of September, oil price was sitting at between $80 and $85, which was about the same as back in January, before Russia invaded Ukraine. The unfortunate problem we may have next month is that OPEC Plus has just agreed to the biggest cut to production since the start of the pandemic. And you can see that so far in October, oil price has started climbing back up sharply. The US has been busy in the last few days trying to influence Middle Eastern countries, trying to revert the cuts to production, but Russia seems to have made friends in the region quite quickly. Putin seems to have built a relationship out of nowhere with Mohammed bin Salman, the Crown Prince of Saudi Arabia, while the United States have distanced itself from the Saudis at the same time. And just 2 days ago, Putin met Sheikh Mohammed bin Zayed from the United Arab Emirates in St. Petersburg. So we'll have to wait and see what happens to the level of Middle Eastern oil production. At the moment, it looks like Russia has the upper hand in controlling that output, and that output is dropping, which means prices are going up. And that means there is a very, very high likelihood that we're not going to see a sustained drop from here. It is likely that energy prices will maybe stay at this current level, maybe even increase further from where they are today. But what that means for inflation is that from next month onwards, we're likely to stop seeing this month-on-month sharp reduction in the cost of energy, which has been masking, it's been hiding the real rate of inflation in other parts of the index. Gas prices were really high in July and August, which is why the energy part of the CPI index didn't drop as much below the oil bit. But gas prices did fall sharply in September, down from $9.20 at the end of August to $6.50 at the end of September. And they have remained low since, despite Russian gas supplies to Europe being stopped. This sharp drop means that energy costs are showing the disproportionately high drop in the CPI data. And there has been an increased focus on replacing Russian gas in Europe with supplies from other providers like Azerbaijan, which has been happening recently, and the US has been sending record amounts of liquefied natural gas on ships from across the Gulf. But it seems to be working because we are seeing this sustained drop in gas prices. They're not going back up. And just yesterday, Putin had his tail between his legs asking if Europe maybe want to change their mind and buy some Russian gas after all, which seems incredibly pathetic after what's happened so far this year. The good news is that lower energy prices should help not just inflation, but people struggling with the cost of living crisis through the winter. If the energy prices stay at this level or even continue dropping, but it is important to remember that the current price of gas and oil is still relatively high when you zoom out historically. It's still really quite expensive. So although they're not as high as they were earlier this summer, we still do have an ongoing upward pressure from energy being elevated compared to what we've seen over the past decade, and this is going to continue affecting the price of other goods. So the inflation data is looking really ugly. It is very likely now that the Fed will continue to increase rates a lot. The next meeting is in about 3 weeks' time at the beginning of November, and we will probably be seeing another 0.75% increase. And if the energy costs increase between now and then, we might even see a 1% move. This could happen, despite all the whining from the people who keep saying that inflation doesn't exist, it's gone away because, the price of some raw commodities has dropped. With shelter prices continuing the rise upwards and energy potentially staying flat or increasing, inflation could become a major problem this winter, if it isn't already. For all the noise about how high interest rates are, they are still way, way below the rate of inflation. It's easy to forget. And the basics of economics just don't lie. The way that inflation is beaten pricing back down is through destroying demand. And at the moment, demand does not seem to be destroying itself. Job data came out recently showing very high levels of employment. The data improved in the last month. Wages have just started to go up. It turns out that the wage inflation spiral is a real thing. Who would have thought? So unless the cost of living crisis causes a very, very sudden organic decline in demand soon, people just stop buying stuff that isn't essential, the Fed will have to increase rates faster and faster to stop inflation spiraling out of control. And that means the cost of debt is going to increase. Companies with large piles of debt built up during the decade of 0% interest rates are going to find out the hard way that money is not actually free. And if you are carrying debt with flexible interest rates personally, things like credit cards, for example, you probably might want to consider paying it down as quickly as possible, because while nobody knows which way the stock market will go, if you're paying off debt that will cost you 10% interest next year or more, you are getting a 10% return on your money no matter what. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.